A very good morning to all of you students. Today we will be discussing and revising the topic of interest rate risk management as well as the business valuation. So let us start, students, our revisionary aspects on interest rate risk management first. So in this topic, we discussed in the recorded lectures, all of you would have seen, we discussed in detail what are the different ways and methods to do the interest rate risk management. And first of all, what is the interest rate risk? Okay. So to start with, what is an interest rate risk, students? Interest rate risk is stemming from two things for which the interest is paid. Now, if we think through that why there is a need for interest, what are the causes for the interest payments? So one, there is a risk of non-payment. So whenever, let's say, a person is giving some amount to another person, so the person who is the lender will expect some return, right, in the form of interest. Now, the first and foremost cause for which the person will expect a return is because there is a risk associated with that lending. Risk of what? Risk of non-payment or risk of delayed payments, right? Because it might happen that in the schedule, it is mentioned that the repayments will happen in these due dates, but the repayments, the borrower who has taken the amount is not able to repay. So there is a risk of both non-payments as well as delayed payments. To cover up for that risk, the person who has lended the money will expect some return in the form of interest. So this is first part, risk of non-payment. Then second, students, all of us know that any currency is not constant. The purchasing power of that currency is not constant.
Recording in progress.
It will keep on changing, right? Now, for example, 100 rupees costs me a one basket of standard products, let's say, as on today. Correct? It might happen that the same basket after 1 year. So this is basically today. So after 1 year from now, the same basket of goods, by basket of goods, I mean the standard set of products. Okay, I'm keeping the products very much similar. They might cost me any amount other than 100, right? In this example, we have taken as 120. So don't you think, students, the value of rupee has gone down? Yes, because earlier only 100 rupees used to give me one standard basket of goods, which now 120 rupees is giving me. So that is why we call this as inflation or time value of money, by whatever name we want to call it, because the money will lose its value. That's the general assumption. Because of that, the interest rate is also needs to be charged, because if I'm lending someone 100 rupees for 5 years, so do you expect that the person will give me back only 100 rupees after 5 years? No, right? You will also expect the loss in terms of the time value of money, the deterioration because of that, or to make up for the inflation, by whatever name we can call, students. Okay. So if we are clear that why, so these 2 points are why interest, right? These 2 points are telling us that why there is a need to pay an interest. Clear, students? Now, since we are clear that why there is a need to pay interest, can we also think of stating that this interest rates are never same? This will keep on changing because these underlying two causes will keep on changing the demand and supply situation of the loans, right? And hence the interest rates at which the loans are given or taken are dynamic. They are never same because they are demand and supply led. Right? Why interest rates are dynamic, students? For example, in an economy, the demand of credit is increasing. By credit, I mean loan, right? So people are demanding more loans. In such a case, the interest rates will increase, right? In case the demand of loan or credit is decreasing, in such a case, the interest rates will also decrease, right? In a way, we can say that it is dependent on demand and supply, right? The demand and supply of credit or demand and supply of loan, and hence the interest rates are dynamic. Now, the moment we say that interest rates are dynamic, don't you think that there is a risk associated with it, which is beyond our control? Correct? For example, in our previous sessions in derivatives and in portfolio, we discussed about the risk concepts. And in that, we associated risk with what? We associated risk with we don't know what is going to be the outcome. Correct? That is what is risk. Or let's say our estimate is very much different from the actual that happens in future. That is a risk. Now that why it is that happening? Because the underlying KPI, let's say here in this, the underlying factor, for example, interest rate we're talking about here is dynamic. So hence it is bound to change. Now the risk is that because of such interest rates, we would have taken some loan or we would have given some loan, right? Either case. And they will be carrying certain rate of interests. And hence, it might lead to the differences in the outcome compared to what we would have estimated. So that is where the interest rate risk comes into the play. So we are talking about interest rate risk. The risk is arising because of the changes in the interest rates that is happening on account of inflation and risk, right? Because interest rates is primarily paid for inflation and risk. The moment interest rate changes, it impacts to the financials of the company, students. It will quickly impact the financials of the company, students. How? Okay, let me tell you. In this discussion, okay. So let's say this is a so this is balance sheet, for example. Okay. And this is P&L, for example. Now, in balance sheet, let's say this is asset side and this is equity and liability side. Okay. Now, in the asset side, we will have a lot of things, right? I'm just taking the things which are, I'm just taking those items which are relevant from this discussion standpoint. I'm taking, let's say, investments, right? I'm taking here borrowings. Okay. Associated with this investment and borrowings, in the P&L, we will have income, interest income, and we will have interest cost, right? Interest cost related to borrowing and interest income related to investments. Now, let's say the investments are done at the rate of 8%. Okay. And the borrowing is actually done at, let's say, MIBOR plus 1%. I will explain you what is MIBOR, which is Mumbai Interbank Offered Rate. Okay. So this is a floating rate. This is a fixed rate. Okay. So what will happen, students? Whatever interest rate comes up or down. So here the interest rate benchmark is MIBOR. Okay. So what is MIBOR, students? MIBOR is basically a interbank markets benchmark rate. So what happens? For example, the credit is taken or given on a retail basis. On retail basis, I mean, let's say I am company or I am an individual, I want a home loan, or let's say company wants some other loan for business purposes, they will approach a bank and bank will lend them. Okay, that is a retail lending. However, there is one another market where the different banks lends or invests within themselves, which is called as interbank market, right? In that only a bank can participate. So this MIBOR is actually Mumbai Interbank Offered Rate. So in the market of the banks, where the banks are participating, what is the interest rate going on? That is called as MIBOR. Okay. And it will keep on changing every moment. It's not static, it's dynamic. Okay. Like a equity share price quoted on a stock exchange also keeps on changing, right, students? In similar way, this MIBOR will also keep on changing. Okay. Hence, we call it as a floating method of borrowing. Here, investments, we will call them as fixed because my rate is log. Now, tomorrow, what happens? The interest rate. So, let's say here I'm talking about interest rate. It moves up. So, in investments, you will still earn 8%, right? So, your income will have no incremental impact. Okay, I'm talking only about the incremental impact. And here I'm, let's say, talking about interest rate goes up by 2%, for example. Okay. If let's say the interest rate is going up by 2%, your income will have no impact, but your interest cost will also increase by 2%, students. So you see so this statement that we have discussed, interest rate changes, impacts financials of the company. Now, what is happening here? P&L, the cost will shoot up. The income will remain same. That means the profit will go down. And hence, what will happen, students? We will be not in a comfortable position. Now, there are ways and means to avoid it, which we will be discussing in the techniques, right? We are just trying to understand the problem first. Okay. I hope the problem is clear. Similarly, if the interest rate goes down, students, by 2%, so we will end up having the same income, right? Income will not even get impacted by a lower interest rate. However, the interest cost will also go down by 2%, students. In a way, interest cost will also go down by 2%. So ultimately, the profit will increase, right? This will be EPS accretive, right? Okay, students, understood? Perfect. So the problem here is that all the companies, you imagine any company, either they will have investment or they will have borrowings or they will have other instruments that are having a benchmark related relationship, or let's say any sort of a relationship with interest. And since interest is not static, it's dynamic, it will keep on changing the either the income, cost, or even the asset and liability. Now, students, all of you have studied about bonds. Bonds, or let's say any security in the form of borrowing, let's say debentures. So, students, what happens? The moment interest rate changes, for example, from 10%, now the interest rate has increased to 12%. And here from 10%, the interest rate has moved down to 8%. So if the interest rate increases, can you tell me bond value where it will go? Whether it will increase or decrease? Similarly, the second part, interest rate decreases, what will happen to the bond value, students? Come on, tell me. You can make use of the Zoom chat box as well as the okay. So I have got a query from Abrikesh. Just a second, students. Let me arrange this. Yes. So Abrikesh is saying interest are contractual. So how can change in bond value? Okay, I'll tell you what happens. You're right. Interest rates quoted on a bond are contractual. But we are not talking about those interest rates that are fixed. So for example, in this case, I have said that investments are done at 8%. So this is a contractual one, right? This is a contractual one. But essentially, what I'm trying to tell you is that the economic environment in which we are operating also have a market interest rate, right? Now, those market interest rates will keep on changing. Now, I'll tell you how. For example, the bonds stated that we will give you 10% rate of interest and they will continue to give you 10% rate of interest, whatever happens. But the moment market rate increases to 12%, the moment market rate increases to 12%, now what people will do? People will invest less in the bonds, which are giving 10% return because they will say that market rate is already 12%. Why should I invest in bonds giving only 10%? So what will happen according to that? The demand will come down. The moment demand will come down, the prices of the bond decreases. Okay. So the bond value decrease. I hope you're able to understand the chain now, Abrikesh. Munish has replied. Munish, your both the answers are correct. Thank you. Yes, Abrikesh, perfect. First option will decrease. Now, in the second option, now think about that in a bond, you have, let's say in a bond, the contractual cash flow for the interest rate purposes is 10%. And it will give you, it will keep on giving you 10%, whatever is your interest rate. Now, the moment tomorrow interest rate, market interest rate comes down to 8%. Now, do you think the investors will increase the demand of these bonds? Yes, because they will say, now the bonds is giving us 10%, market is giving us 8%. So we should quickly invest in the bonds. So the demand will go up. The moment demand will go up, the price of the bond will also go up. Okay, this correlation is clear, students. Now, it gives us the second takeaway. So the first takeaway was what from here? Change in interest rates impacts P&L related income and expense. And the second takeaway from here is that the change in interest rate also impacts the value of asset slash liability. Correct? It also changes that. Now think if you have invested in a bond or if you have issued your bond. So both your assets and liabilities value will undergo a change, right? And hence, now can we say that any interest rate changes impacts the financials of the company? Yes, it will impact your P&L. It will also impact your balance sheet. Okay. Okay, students. I hope the problem is clear because in this interest rate risk management, first we need to understand that what is the interest rate risk, what are the implications of such interest rate risk, and then we will come to how we can manage it, students. Okay. Any questions till now, students? Okay, now let us come to the management of the interest rate risk. So any risk, if we want to manage, that process is called what, students? Come on, tell me. The process of making sure that the risk bonds or debentures are not perpetual unlike deposits. No, even deposits for that matter can have a fixed term. Okay, so it depends. So even bonds and debentures can be perpetual with some of the terms and conditions attached to it, saying that it will be converted into equity, something like that, right? So, Abhikesh, which deposit are you talking about? Are you talking about the deposits to the banks, fixed deposits, or deposits to the regular companies? Even for that matter, even bonds or debentures you can invest at any time, Abhikesh. There is no restriction as such. Whatever debentures are available in the market, you can go and invest in that. Okay. The secondary market, bonds and debentures are always available. Okay. And they can have a fixed term because earlier it used to happen that irredeemable bonds can be issued, but now I think there is a legal restriction on issuing a irredeemable bonds. It has to be always redeemable or convertible into equity shares. Okay. So there can be lots and lots of terms and conditions attached to the bonds or debentures because it can be, let's say, convertible at the option of the equity, at the option of the issuer. It can be convertible at the option of holder, right? And it can be convertible upon happening of the some event in future. So there are lots of terms and conditions that are attached. Now, uh, the question I asked is, what is the process of managing any risk called as? Now, in students, it is very clear. In risk, there is a upside or there is a downside, right? For that downside means that our P&L will be worse, right? Our P&L will go down. So the profits will go down. So in case I see that my profits are going down, so I will have to do some activity in a way that the other instrument, or let's say the instrument which I'm using to manage that situation, gives me a higher profit. Okay. So what is this process called, students? Yes, very good, Abrikesh. Munish, and I can understand who else has joined. At least Zoom I can't see, but are there any other people who have, are there any other students who have joined? Please do respond on any platform wherever comfortable. So yes, this is called as hedging, Abrikesh. Perfect. Yes. So the process of that management of the interest rate risk is called as the hedging. So this is hedging of the interest rate risk, students. Now there are two broad methods. First one is the traditional method and second one is the modern method. So in case of a traditional method, students, what happens? We have asset and liability management, and second one is the forward rate agreement. This is very, very important. Forward rate agreement, FRA, is very, very important. Asset and liability management is more used in banks and NBFCs. ALM, which we call as ALM method. Okay, and banks and NBFCs use it most, but this process can be applied in another company also. Sorry. Okay, students. Now we will go into detail. What are they? Modern methods. So in modern methods, we have interest rate futures, interest rate guarantees. Lastly, we have swaps, which is called as interest rate swaps. So let's start our discussion with the asset and liability method, students. Now imagine a company. Okay, I'm just taking a very simple example, a very simple operational example. Imagine a company which is into, let's say, sales and purchases, right? It's just doing a simple trading method. Okay. Now, the major things or the major cash inflow is only because of the sales that the company is trading the goods, right? And the major cash outflow would be in the form of the purchases that the company is doing. Now, if you see, the company's collection is coming on 90 days. Okay. So there is a agreement in place with the customer that the customer will pay to the company in 90 days after all the sales. However, to the vendor, the company has to pay within 30 days. Okay. And within 30 days of even procuring. Okay. And another 30 days, let's say the inventory has to be kept. So that part I'm ignoring as of now. I'm just linking the asset realization cycle is 90 days. Liability payment cycle is 30 days. Now for 60 days, the business has to arrange funds, right? Because what will happen? The business will pay on the 30th day. So this 60 days run has to be covered by the business. Now what business can do? Business can borrow on 30th day for another 60 days, correct? So that the 90 days realization, whenever it happens, the company can repay it to the bank. Or the second option is it can ask the customer to prepay on 30 days and let's say take some cash discount by preponing the payment, not cash discount, but let's say early payment discount. Second, there is another option. The company can ask vendors to extend the credit period from 30 days to 90 days, students, right? So in all these cases, what we are doing, or any one of you think, is there any other way? Please also do let me know. So one is to have a borrowing on 30th day and again repay using the collection on the 90th day. Second is reduce the collection cycle. Third is increase the payable cycle. Very good, Abrikesh. Abrikesh has mentioned bill discounting. For the 90 days, let's discount our bill on 30th day so that after we discount it, we use the proceeds to pay it to the vendor. Okay. So bill discounting is another part. So In all these cases, we are trying to match the asset realization cycle with the liability payment cycle. This is what the asset and liability method is. In this process, first of all, we have to see that what are my payments, or let's say what are my cash outflow timings. On the other hand, we also plot that what are the cash inflow timings, and we try to match them. I've just taken a very simple example of 30 and 90 days, but in practical life, every day, typically there is some big payment or there is some big receipt that is happening. So if we match our payments with the receipts, or we match our receipts with the payments, then we will be able to better manage our risk. Because in that case, there will be very less need of either investment or borrowing. And hence, we will not be exposed to the interest rate risk, students. Because the moment you borrow or invest, your interest rate risk starts. Correct? Clear? So, asset and liability method, students, timing of cash inflows and cash outflows, matching the assets maturity with the liability maturity. Simple. We're trying to match the assets maturity with the liability maturity. Okay, students. Now let's come to the forward rate agreements. Okay, before we come there, I was about to tell you that for banks and NBFCs, there are different models in ALM that are used to track, and using those reportings, and there are a lot of reportings also happens to the government, to RBI on these ALM amounts. And this is very crucial activity from the bank's standpoint. Okay. Now, second part is the forward rate agreement. Now, in case of forward rate agreement, students, we used this case study to understand really what is the background of the forward rate agreements. Okay, so Abrikesh is mentioning in earlier times when clearing of checkbook took more than 3 days, then there was a system of paying on float. Okay. Perfect. Let's start our discussion on the forward rate agreement, students. Now, forward rate agreements, we said that let's take an example of two banks, Bank A and Bank B. Bank B needs to borrow. So, students, whenever we talk about the interest rate risk, we have to be clear what is the situation that we are dealing with. If the situation is of the borrower, the things will be very much different. If the situation is of the lender or investor, the situation will be different. The dynamics will become different. So Bank A is in the need of borrowing after 1 month for 3 months, correct? So in a typical financing arrangement, what all things you can think of? You can think of the time period. Let's say what is the time period, right? You can think of what is the rate, right, at which the borrowing or lending will happen. What is the amount? So all these standard terms and conditions should be part and parcel of the arrangement. Okay. So here Bank A needs to borrow after 1 month for 3 months. Now, this is something new, right? This kind of information is something new, that the borrowing should not happen today, but the borrowing should happen on a later date. So students, till now, in our understanding, all of us would have thought that if we have to borrow, we'll just go today, ask for the funds, borrow it, and agree on the terms and conditions and take it ahead. However, is this type of a borrowing also available in the market where the borrowing is not happening today? but it will happen on a later date. Yes, that is available. So again, I'm trying to tell you about the situation here. The situation is that after 1 month, the borrowing has to happen. Similarly, for bank B needs to invest, okay, for 3 months, and after 1 month. So after 1 month, the investment will happen. But for how many months? For 3 months, students. And again, the amount will be 1 lakh rupees. The current interest rate is 5% per annum. And there is a forward interest rate quoted of 1 month at 6% per annum. Now, here is the cash, students. So in the market, if you see, if you see, there are two types of market, right? One was the spot market or the cash market that we have seen, and second one was the futures and options, right? Futures and options will have the prices or will quote the prices which are more forward looking, right? Which will be applicable after, let's say, that stipulated time period. For example, in case of a equity share futures, we said that 1 month, 2 month, 3 month expiry, right? 4 month, 5 month, 6 month, like that. So that price will be applicable after that stipulated tenure. Similarly, in interest rates, there are two interest rates. One is the forward interest rate and second one is the current interest rate. So the current interest rate, in case I want to enter currently, this interest rate will be applicable, and forward interest rate is basically if I want to enter into a investment or borrowing after 1 month, then 6% per annum will be applicable. But this rate will get logged today. The forward interest rate will get logged today. Okay. If I go ahead with the deal, students. Okay. So we come to this part. 0 month, we are standing. And we anticipate that after 1 month, 6% is the forward interest rate. That is again quoted in the market, students. That is again quoted in the market. And the duration has to be 3 months, right? So after 1 month, the investment or borrowing should happen for 3 months. That means 1 into 4. This becomes my forward rate agreement, students. After 1 month, for 3 months, I have to invest or borrow. So this becomes 1 into 4. So why 4? Because after 1 month, for 3 months. So 1 plus 3, 4. Or otherwise, you can say 4 minus 1 will give us the tenure. And 1 will give us the starting point. Now tell me, students, FRA 3/6, what it will mean? Loan starting when and for what tenure, students? So loan starting when? Yes, Abrikesh. 3 months and ending on 6th month. Yes, perfect. So 3/6 is starting on 3rd month and ending on 6th month. Or we can say starting on 3rd month for a tenure of 3 months. Very good. 12/18. Yes, come on. This is a bit different. 12/18 will mean what? If I say FRA of 12/18, essentially This forwarded agreement is quoted through this symbol. The reason being that this is a standard, let's say, notation that is followed. Okay. So FRA 12/18 will mean loan will start after 12 months and it will have a duration of 6 months. Yes, Manish, I've got a response now after 3 months. Yes, perfect. I think in this you would be replying. So here it is 12 months and 6 months. Perfect. Duration will become 6 months. Okay. Now let's take it ahead. Now bank A. Now think it. It's a very important discussion. Yes, Manish. After 12 months, ending 18 months. Very nice. Thanks, Manish, for answering. Thanks, Abrikesh. Now, in this case, let's say Bank A and Bank B are two banks, as we discussed in our example, and both of them have one specific need. Bank A needs to borrow, Bank B needs to invest. But they both of them needs to borrow or invest for 3 months after 1 month. Okay. And let's say they said that, okay, our 1 month forward rate is around 6% per annum. So let's take that. Let's go ahead with that. For the 0th period, the 6% per annum continues, right? Which is fine. In the first period, what comes out as an actual will depend on who has won and who has lost. Because again, it's a commitment that is happening as on today. Correct. Now, if you see, actual interest rate is 8%. After the first month gets over, the actual interest rate comes out to be 8%, students. Now, what will happen? Simple. Bank A is having 6% at the rate of 6% to borrow. Now, the actual interest rate is 8%. So, what will Bank A say is, I have a contract to borrow at 6%. Market interest rate is 8%. I am at a gain of 2% due to this instrument. Correct? And here, what will Bank B say? Bank B will say that I had agreed to invest at 6%. I had agreed to invest at 6%. The market interest rate is 8%. It would have been better for me to invest in the market at the actuals of 8%, right? Because that would have given me a higher interest rate. But since I have committed at the rate of 6% for the investment purposes, I will make up a loss of 2%, students. Easy and simple. No, it's not only notional, it's actual. Actual gain or loss will happen, right? While we discussed about in the derivatives, uh, the situation that happens on account of forwards and futures, the settlement happens on actual basis, right? It's not a notional gain or loss, right? So the net payoffs has to happen or the execution of that contract has to happen, right? So one is gross and gross and second is net and net. Those settlements we have discussed. We will discuss in this context as well, how will that phase out. Now let's say the actual interest rate, this is a case 1 actually, and this is the case 2. So in case of case 2, the actual interest rate is 5.5%. Then what will happen? In case the actual interest rate becomes 5.5%, now think it from Bank A's perspective. Bank A will say, I have a commitment to borrow at 6% per annum. However, the market is offering me only 5.5%. So I would have been in a better position if I would have borrowed it from the market. Now, because this is a commitment, I am end up losing 0.5% compared to the market. In this case, students, if the actual interest rate is 5.5%, Bank B has committed to invest at the rate of 6%. However, the actual interest rate in the market is only 5.5. So with that logic, Bank B will be happy because Bank B will say that I am able to get better return than the market return. So it will say that I will gain of 0.5%. So the payoffs are clear. I will tell you how the payoffs will get calculated, but at least this part is clear that which party gains and which party loses. And again, I said that Bank A is a borrower and Bank B is a investor or lender, the one who lends the money, right? So can I say that for all the borrowers, in case they have entered into the FRA to borrow, in that case, if the interest rate goes up more than the committed percentage, then they will gain. Yes, there is a gain. For all the investors, in case the interest rate goes down compared to the committed percentage, then they will also gain. Okay. So borrowers, interest rate goes up, they gain. Lenders, interest rate goes down, they lose. Borrowers, interest rate goes down, they lose. Lenders, interest rate goes up, they lose. This is what we have discussed. Okay. Easy and simple. Now, see how the settlement will happen. As I said that there are two ways of settlement. In the derivatives also, we studied that what are those two ways? One is gross and gross, second is net and net. So first one is actually Bank A would get. This we are talking about net settlement. Okay. So for case one, we said that Bank A would get 2% and Bank B would pay 2%, right? Here is what we said, gain of 2% and loss of 2%. So Bank A, how that calculation will be done? 1 lakh was the notional amount. 8 minus 6 is the difference of 2% that is coming, right? 8 is my actual rate. 6 was my committed rate. And this is applicable for only 3 months, right? This is applicable only for 3 months. And if you see only the numerator part, this will give you the value after 3 months, right? We have to arrive at the value at the start of the 3 months. So this is the present value factor that will get adjusted for, and hence 490 becomes my net payoffs. So the present value at the start of the loan, that is after 1 month from today. So see students, now what happens, the way FRAs are devised is that today I'm entering into a commitment. Okay, let me tell you here. So this is the 0th day. On this day, I am entering into a commitment. First month, This is start of loan. Sorry, this is 4th month. And this is end of loan. Okay. So start of loan and end of loan, 1st month and 4th month. That is how it happens in our example, right? Because we are talking about FRA 1/4. Now, students, if you see, on the 0th day, only commitment happens. Only contract happens. Nothing happens in terms of the cash outflow or cash inflow. CO, CI is not there. Cash outflow or cash inflow is not there. However, when it gets started on the 1st month, this is where the settlement happens. Generally, the settlement happens on the start of the actual loan as per the FRA. But in some cases, you will see while solving the question has specifically asked you that the settlement will happen after loan period, students. Okay. So just go through the exact question requirement that when the settlement is happening and accordingly arrive at the amount. Now, if you see 2%, so 1 lakh into 2% into 3/12 will give us, so this is 2000, 2000 by 4, around 500 rupees, right? Correct. So if the settlement is happening here, it will happen at 500 rupees. If the settlement is happening on the 1st month, it will happen at 490.19, students. Okay, clear? So that is how we have calculated. Now let's come to option number 2. In option number 2, we said that bank will lose 0.5 and bank B will gain 0.5. The moment bank B will gain, why? Because the actual interest rate has gone down, right? Bank B has agreed to invest. That is why it is gaining. Now the calculation will be very much similar. 1 lakh into 0.5% for 3 months. Again, taking a present value, we will arrive at 123.31. Clear, students? Any queries or any doubts till now, students, please do let me know. This is the very basic formula. So in a way, for FRA, what all things we need to keep in mind? FRA always think it from the borrower or investor perspective, right? The perspectives will get changed. Hence, I'm saying that think always that who are or what is that we need to expect or solve for. Okay, it's for borrower or investor. Second is what is the agreed rate and what is the actual rate. If I am a borrower, interest rate goes up, I will gain. If I am an investor, interest rate goes down, I will gain. Simple. In other cases, I will lose. Now let's see about the payoffs. So this payoffs is nothing but the same. N is the notional amount, RR is the actual rate, FR is the forward rate, and T is the time period, which is duration, students. Now, bank A borrower, we call it as the person who has purchased the FRA. And anyone who has purchased any instrument, we call them as taking a long position, right? interest rate goes up, gain also goes up. Interest rate goes down, gain goes down. Simple. Bank B, from a lending perspective, we are talking about, we call them as they have sold the FRA. They have short sold the FRA. We call this as a short position, students. In this, if interest rate goes down, gain goes up. Interest rate goes up, the gain goes down, students. Clear and simple. So can we understand? I mean, can we keep in mind that purchasing the FRA is as good as borrowing under an FRA? Selling the FRA is as good as investing or lending under that FRA, students. Okay, clear? Any other doubt till now? Okay, now this is again very, very important. So students, if you see in derivatives, we have first of all discussed about the different types of derivatives, right? Which is forwards, futures, and options. These three were there. What are the products details over there? And lastly, we also discussed how do we value such FRA or how do we value such derivatives. Now, this valuation is very important, students, right? Because ultimately, the question will ask you either to value the FRA and then to arrive at some of the additional things, right? Now, think it. Let's think about a FRA of 3 by 6. We're talking about the valuation of FRA now. Okay. Now, here, the valuation is for FRA 3 by 6. That means the borrowing will start after 3 months and it will end after 6 months. Duration is 3 months. Okay. Now, if you see, sorry. Now, if you see, we are standing here today, right? Then we have 0 to 6 month visibility. Okay, one more thing. In the MyBoard discussion, I discussed with you that there is a benchmark rate that comes from the interbank market. But for different maturities, there are different rates. It's not that simply in the MyBoard it will say 7%, that's all. No, it's never like that. MyBoard is always quoted in reference to the maturity. Example, MyBoard 3 months is, let's say, 7%. MyBoard 4 months, or let's say 6 months. Let's take an example of 6 months, 7.5%. But this is quoted again as a per annum basis. Okay. So what does this mean? And let me take another example. MyBoard 15 months, 8% per annum. So students, you would have seen, while let's say you would be booking any FD, fixed deposits for you. I'm just taking a very practical example, which all of you might have, seen. The moment you book a FD with any of the bank, if you specify the tenure as higher, let's say if you say that I am booking a FD for 1 year, you will get a better rate of interest. Vis-a-vis, if you say that I am putting up a FD only for 3 months, putting up a FD for 3 months, you will get lower rate of interest. What is the reason? Why increase in time, or let's say increase in maturity is leading to increase in interest rate. What is the primary reason, students? Come on, can you think? Can you think and attempt? This is very, very crucial actually. Increase in maturity is leading to increase in the interest rates. Why this will happen? I can relate it back to the interest rates. Why interest rate is paid? There were two reasons, right? One is risk, and second one was inflation. So don't you think if you increase the maturity period, the risk also increases? Because I can say that there is a lower risk that the counterparty might go for bankruptcy in 3 months, but there is a higher risk that the counterparty might go for a bankruptcy in 15 months because 15 months is a big period. So basis the today's situation, I can assess that after 3 months, the situation will be pretty much same. There is very less risk. However, after 15 months, I don't know what the situation is going to be. It's a very long period. Manish is saying bank can lend for higher period. Yes, that is okay. Bank can lend for any period you want. Okay. Today you want to go for a home loan, they will ask you what maturity you want. The question I'm asking is why higher maturity periods have higher rate of interest, whether it is a borrowing or whether it is a lending. The reason is higher maturity period will lead to higher risk. Okay. Higher maturity period will lead to higher risk. And hence, to cover up that for a higher risk, the higher interest rates comes into the picture. Now, where were we? Yes, we were discussing about the valuation. Okay. Okay. I think I am getting a lag in terms of receiving the queries. No worries. So yeah, let's come back, students. As I was saying that 6 months is 5%. Sorry. I was saying that the MIBOR will get quoted for different maturity periods. 3 months, 6 months, 15 months. Simple, right? Now, from that, can I say that I have to just take 6 months and 3 months because my loan will start after 3 months and it will end after 6 months. So essentially, I have to think about this third, fourth, fifth, and sixth month, right? What is the interest rate going likely to be? So for that, I just need to know what is the interest rate for the 6 months and what is the interest rate for the 3 months. Simple. So here it is. For 6 months, the interest rate is 5% students. For 3 months, the interest rate is 4% here, right? And next 3 months, let's assume it to be X. The moment you do this, we are just equating the two breaks. Let's say 0 to 3, 3 to 6, and we are equating it to the 6 months interest rate, right? That is how the market will be in no arbitrage position, right? So X becomes 5.94. This we also call as a theoretical minimum value. Clear? So at least 5.94 should be the 3 to 6 months FRA quoted price in case 6 months interest rate is 5% and 3 months interest rate is 4%. Okay. Clear, students? And if you see this equation also, what we are doing is we are just simply taking the percentages, multiplying it with the time to which it is effective, right? Now, if you feel that FRA is available at lower than 5.94, right? Theoretical minimum value is 5.94, students. And if you feel that the FRA is available at lower than 5.94, then what will you do? FRA is underpriced. The moment you say FRA is underpriced, we call it as a long position in FRA, right? Whenever something is underpriced, we purchase it. By purchasing, we mean we call it as a taking a long position in FRA. Hence, we call it as borrowing through FRA. We discussed above, right? If someone wants to take a long position in FRA, that means that person has to enter into a borrowing position through that FRA. Okay. Now, in case the rate is lesser than 5.94, so what you will do? You will borrow through FRA. 3/6 you will borrow here. Now, the moment you borrow here for 0 to 3 also you need to borrow. Correct? Because what will happen, the 0 to 3 months borrowings, when you have to repay it, you will repay it using the borrowings that you are doing under FRA of 3/6, right? And what will you do with this amount? You will invest it for the 6 months. Correct? You will invest at what rate? 5%. Borrow 3 months, you will borrow at 4%. Right? And this FRA is lesser than 5.94% as we discussed, right? So whatever is that rate, you will borrow. So see, students, borrow 1 is this for 3 months, 1 lakh rupees, let's say becomes 1,03,000. Okay. It will become, let's say, 1,03,000. I'm just taking an example here. Borrow 2, you will use that proceeds to repay it 1,03,000. And ultimately, after 6 months, borrow second. The final amount that has to be paid is 1,06,000. Okay. And here you have invested this amount for 6 months. The amount comes as 1,07,000 minus 1,06,000. So ultimately you will gain around 1,000 rupees, students. Clear? So ultimately, this is your cash outflow after 6 months and this is your cash inflow after 6 months. Always think it from the cash outflow and cash inflow perspective, students. Now, Munish is asking, it should be added, not multiplied. Are you referring to this? This multiplication is correct only. This should not be added. Reason being, I'll tell you the reason also. So here you are saying 1 plus 4% into 3/12. So you will arrive a value here on that value. So the moment you're doing 1 plus, that means the principal is also part of it, right? 1 plus means principal plus interest. So this is principal and this is interest on 1 rupee, right? This is how it means. So this value is actually the final repayable value under borrowing 1. Now that has to be taken for the next 3 months, and hence we multiply in that what is the new rate of interest here. Okay, it should be multiplied only. Clear? Now case 2, where FRA is available at higher than 5.94 students. Now see, in case it is available higher than 5.94, then FRA is overpriced. The moment anything is overpriced, you sell it, right? Because selling it will give you a gain. So you sell FRA. You sell FRA means you have a short position in FRA. Short sell FRA, invest through FRA. Now, the moment you do this, in FRA you are investing. So 0 to 3 months also you need to invest. And for 6 months you need to borrow. Okay. So what will happen? On 0th day, you are borrowing for 6 months. Whatever proceeds comes to you on the 0th day itself, you invest for 3 months. And after 3 months, whatever proceeds comes to you, you again invest for 3/6, which is after 3rd month, you again invest for 3 months more. So ultimately, what will happen? From your investment too, you will reap some amount. And from here, you will also have to repay your borrowing. So whatever is the difference between your cash outflow and cash inflow, you will get a benefit out of this. Okay, students. Now, we also discussed how we do the gross and net settlement, students. So gross is whenever you pay or receive interest basis the FRA. You 100% pay and you 100% receive. In case you have borrowed it through FRA, you have to pay the interest. In case you have invested through FRA, you have to receive the invest. So no need to pay any difference, students. So if I connect it back to the derivatives, students, how gross settlement used to happen in derivatives? Let's say you have entered into a forward of purchasing a equity share. So at the end, you will end up purchasing the equity share, taking the delivery of that equity share and paying up the amount at which you have locked the forward, right? In case of net, the payment or receipt of the interest happens basis actual market interest. In this case, only the difference is paid. Like in the above example where we discussed about actual market rate being 8% or actual market rate being 5.5%, students. So need to pay or receive the difference on account of the FRA. This example above that we have discussed. Clear, students? So just to recap, what all things we discussed till now, we discussed about the interest rate risk management. In that, we have just tried to understand that what is the real problem of interest rate risk. In that, we discussed about the 2 reasons why interest is paid. Because of those 2 reasons, there is a demand and supply gap always of the credit or loan in any economy, which always leads to the changes in the interest rate. The moment you change the interest rate, it has a bearing on your financials, be it your profit and loss or be it your balance sheet. Now, please connect everything as I'm speaking. It will impact your profit and loss directly by impacting your finance income or finance expense. It will impact your balance sheet by having a differences in the valuation of the investments in bonds or debentures or borrowing through bonds or debentures. And hence there is a need for the proper management of this interest rate risk. The process of management of this interest rate risk, we were calling it as the hedging part, right? And how are we going to do that hedging? There were two broad ways, traditional and modern. In traditional, we have discussed about the asset liability management and forward rate agreement. In case of traditional, which is the asset liability management, we discussed that in this case, the companies or the banks or NBFCs will do all the possible permutations and combinations so that their cash outflow timing is matched with their cash inflow timing. And the reason is it will lead to minimal investments, minimal borrowings, and hence the impact will be minimal. Okay. Second one was the forward rate agreements. Forward rate agreements will cover up to you not only for the current period, but even for the forward borrowings or investment needs. It will lock the rates for you, but it's like a commitment. It's like a contract. It's not an benefit. It is not always beneficial because sometimes you might lose also, as we have discussed, right? It depends on the interest rate movements. And lastly, we also discussed about how are we going to do the valuation of an FRA. At what right price can we really value this FRA? The moment it happens, you can also arrive at the theoretical minimum price. Using that theoretical minimum price, you can devise your arbitrage strategy by comparing the rates of 6 months. I mean, in our example, by comparing the rates of that overall maturity compared to the maturity when the loan is going to start. Correct? And then we discussed about the two modes of settlement. One is gross and second one is net. Let's come to interest rate futures, students. Now let's come to the modern ways of hedging the interest rate risk. So interest rate future, students, correct. So this discussion we already did. What we discussed is, let's imagine a bond. Now that bond is giving a contractual interest of 10%. Let's say once it is issued. And it is issued for, let's say, 1 year. Now for that 1 year, there will be changes in the interest rates. The moment interest rate changes right after 10 days, from 10% to 12%, the bond's value is going to decrease. And this is what we are showing it through this equation. Bond's price is inversely proportional to the interest rate changes. By inversely proportional, we mean if the interest rate increases, the bond's price will decrease. If the interest rate decreases, the bond's price will increase. Clear, students? Now, why we are bringing out the bonds discussion here, students? Right? Some of you might thinking, we are talking about interest rate futures. What are bonds doing here? Now, let me tell you the way interest rate futures works. Because in interest rate futures, there are, okay, before that, from our derivatives knowledge, we understand that forwards are OTC products and futures are customized one. Correct? Forwards are OTC products and futures are customized ones. Sorry, wait. Futures are standardized ones. Okay. These are very much standardized, listed on the stock exchange, right? Now, the moment we say standardized, it's difficult to standardize the IRF, interest rate futures. What we do is we use the relationship of bonds with interest rates and take our call accordingly. Okay, tell me one thing. In case we are talking about the FRA, forward rate agreement, I'm talking about the hedging part. If I foresee, I'm into a borrowing situation, right? Now, in that situation, if I foresee the interest rate going up, right? Then should I borrow FRA or should I sell FRA? Tell me, students. In case, no, not sell. Please again try to understand. I'm saying if the interest rate goes up, I will lose. If the interest rate goes up, I will lose. Simple. So then FRA should I purchase or should I sell? I should purchase, right? Because if the interest rate goes up and I'm losing, right, on my current instrument. So what I will do, if the interest rate goes up in FRA, I will gain because of the interest rate going up if I have purchased that FRA. So that will help me in the strategy, right? Okay, tell me one more thing. If the interest rate goes down, I will lose. This is my current situation. So what should I do with my FRA? Should I purchase my FRA or should I sell my FRA? I should sell. Very good, Abrikesh. So now let's think about from the bonds perspective. If the interest rate goes up, I will short sell the bonds futures. Why I'm short selling? The moment interest rate goes up, okay, let me just tell you, interest rate goes up on my underlying, I will lose. Okay. The moment interest rate goes up, I will lose. So what should I do with the bonds then? The moment interest rate goes up, bonds prices goes down, right? So I have to cover up for a situation where bonds prices goes down, then the company should gain. In which situation it will happen? Yes, very good, Munish Kumar Gupta. Sorry, I got your responses now. Purchase and sell. Yes, very good, Munish. You were right. Now let's come back to this case where I am sitting on a risk that if the interest rate goes up, my underlying, I will make a loss, right? On this underlying, I will make a loss. So if the interest rate situation is going up, definitely I would want the bonds value to go down. Then only I will be gaining, right? So in which cases where the bonds prices will go down, I will gain. Once I bonds futures, I short sell them, right? I take a short position. I think Ambrikesh, your answer is correct. Very good. Very good, Munish. Your answer is also correct. Perfect. So bonds futures, once I short sell, I will be able to cover up for any increase in the interest rate related losses, right? In case the interest rate is going down. And with this, I will incur in underlying a loss. Then I should expect the bond prices to go up For this, I have to take a long position here. Clear, students? So the strategy is clear, right? How we can devise the strategy. Ultimately, the strategy has to be taking into account the inverse relationship of bonds and the interest rate, students. It's simple. Okay. Any questions till now, students? So interest rate future, students, makes use of bonds as the underlying instrument. And we have to be careful in devising our strategy because bonds prices move in the reverse direction of the interest rates. And hence, we can make use of this strategy where we want gain to happen to us in case the interest rate goes up. We need to short sell our bonds. In case we want gain to happen, in case we want gain to happen for the interest rate going down, in that case, we have to take the bonds purchase. We have to do the long position in bonds. Who can do these transactions? Abrikesh is asking. Abrikesh, anyone can do these transactions because bonds, futures, you can sell or purchase in the open market, right? That is why it is interest rate futures. Individual also, I might not, I mean, I am not having a knowledge around it, whether individual or a company can only do, right? There might be some regulatory restrictions, although, right, which is dependent on the different stock exchange to stock exchange, their bylaws or their requirements or rules. So that has to be seen. Okay, Brikesh. Okay, so let's take a break of 10 minutes, students. Then we will take up the other parts. Okay. So welcome back, students. Perfect. So we've discussed about the interest rate futures in details. Let's come to our next topic. Yes. So this is just a simple comparison, students, on forward futures and options when we compare it to the forward rate agreement, futures with IRF, and options with interest rate options or guarantees. So in derivative, students, forwards we discussed on equity shares mostly, right? As an underlying having equity share, although we discussed about some of the new, let's say weather, electricity derivative, all those things also we discussed later on. Similarly, futures also like that. However, in interest rate risk management, the forward rate agreement underlying is the interest rate risk. Similarly, for interest rate futures, we use bonds to manage the interest rate risk. And options is equivalent to the interest rate options or guarantees. That is what we're covering now. So this is the fourth method. And this is one of the modern methods to do the hedge of interest rate risk management. So first of all, students, I will borrow some of the learnings that we have done in the derivatives, right? What was it? That an option is a right. It's a right, but not an obligation. It's not a commitment as such, right? It's a right. Whether you want to exercise it or not, that depends on a lot of other factors. Okay. And that is where we call that it can be exercised under favorable conditions, students. If it is unfavorable condition, it cannot be exercised. If it is a favorable condition, it can be exercised. That's what we are saying, need not be exercised for unfavorable condition. It is some kind of a insurance to you. It is some kind of a guarantee to you, right? That this guarantee is there to you. In this, there are two kinds of options, or I can say interest rate options. One is cap option. Second is floor option. Okay. Like in our regular derivatives, we had call option and put option, right? Call option is the instrument that helps in buying, right? Put option is the instrument that helps in selling. So students, cap option. Cap option is actually, if you see, let's take an example of A. A is what? A is a contract. Contract, right, privilege, but it's not an obligation. Right of what? Right to borrow. In the call option, what it was? Right to buy. Here it is right to borrow a specified amount. There it was a specific security. In the call option, it was a right to buy a specific underlying security. Here it is a right to borrow a specified amount, which is a notional amount at a specified interest rate. Okay. At a specified interest rate, even the interest rate also becomes specified and on a specified date. This is called as a cap option, students. So when it will happen, at what rate it will happen, what is the amount, and what is the nature? Nature is borrowing, right? So the borrowing is happen under this contract for a specified amount, for a specified interest rate on a specified date, student. This is called as a cap option, students. Easy and simple. Now with this, we understand that it's a borrowing related situation. Now, whenever it is a borrowing related situation, the amount goes up and we end up incurring a gain, right? That is how it happens. Here the interest rate goes up, the gain will start to come in. Cap option is clear. Now, there is a different buyer and seller of a cap option, right? The buyer of the cap option will borrow in case the conditions become favorable. The seller of the cap option will have to invest or will have to lend in case the conditions becomes favorable. Or we have used the term in the money, out of the money, right? Call option as in the money and call option as out of the money in the favorable and non-favorable situations, students. Now let's come to the discussion why it is called as a cap option. Can anyone of you tell me, Munish or Abrikesh or anyone else who has joined? Maybe you are seeing it. I welcome all of you to please answer or please put down your thoughts, whatever you think, students, because then it will be better interactive. Why it is called as a cap option? Why it is called as cap? What is the genesis or what would be the reason for that? Come on, students. Think and then answer. So the reason why it is called as a cap option, students, is, yes, I've got one answer from Munish. Nice. It's a fixed amount. Okay. So I'll tell you why it is called as a cap option is it will cap your interest rate percentage. Correct. Because the moment, so we are talking about the specified interest rate. Let's say this is 10%. So it will cap your borrowing percentage to 10%. The moment it goes more than 10%, then a cap option holder will exercise this option because this option will become favorable, right? And hence, maximum interest rate that a cap option holder for this arrangement will have to bear a rate of 10%. That is why it is called as capping of the interest. We have capped the interest. Anything beyond 10%, this option will get exercised and the overall effective borrowing rate for the holder of the cap option will be 10%. Right? Now, there are two ways to settle it again. One is a net basis. For example, the cap option holder borrows from the open market and the rate is 13% or let's say 14% for that matter. Now, 4%, the cap option holder will get a payoff under this instrument because 14 minus 10, that is where the cap option will trigger. So 4% he will get from here, 10%, 14% he has paid. So 14 minus 4 effective is 10. Or second option is the gross basis of settlement in which the cap option holder will exactly borrow the 100% amount at the rate of 10%, irrespective of what is going into the market. That is why it is called as a cap option, students. I hope I'm clear. Now a floor option. Floor option is again, we are saying that A is an instrument, which is again a contract. It is a contract, and in the form of a contract, it is a right, and hence it is a privilege, but it's not an obligation. Of what? To invest. Now see the difference. Here it was to borrow. Here it is to invest or to lend. A specified amount. Okay, a specified amount with a specified interest rate on a specified date, students. Simple. Clear and easy. So here the context changes from a borrower to an investor. The amount specification is as good as the notional amount, right? Because if there is no amount, how we will calculate the interest rate differentials? Interest rate is the strike price equivalent number. We have discussed, right? Strike price, exercise price. This is that equivalent number, interest rate, and this is a duration. Is this clear, students? Now, why it is called as a floor option? Come on, students, tell me. I can expect some answer. Yeah, sorry. The floor, why it is called as floor? Yes. Abrikesh, you're right. Manish? So why it is called as floor is because beyond this, the if you are investing below this, you will not get as a return. You will get a return at least of this percentage, right? The moment your interest rate falls below the strike price, then what will happen? The floor option will become favorable and the person will exercise this option. And by exercising the option, the minimum rate of the strike price will be maintained, students. Okay. So there is a holder buyer, there is a seller borrower. So the holder or the buyer of the cap and floor will have different positions as a borrower or investor that we will discuss now, right? Similarly, the seller or borrower of the floor option or the borrower will have a different position. However, in the regular options that we discussed in derivatives, we said that there is a premium involved, which is what we are even saying here as well. There is a premium on the cap or floor that is to be given because you are getting insured, right? There is some kind of a insured percentage of the interest. If you are borrowing, then your maximum interest will be this. If you're investing, then your minimum interest will be this. Investing is for the floor option, borrowing is for the cap option, students. Clear? Now, paid by the buyer and received by the seller. Premium will be definitely paid by the buyer. Buyer of what? Buyer of the option, whether it is a floor option or whether it is a cap option, right? Now, the buyer of a cap option ultimately becomes the borrower, right? Because this buyer of the cap option is entering into an instrument to borrow. The floor option is the investor because here the investor, basically the buyer of the floor option, is entering into a contract to invest, right? So do you see the change in the situations that is happening? Similarly, the seller of the option, we are talking about the seller of option here. And here we're talking about buyer of the option, students. So the seller of the option under a cap will become an investor, because the moment it becomes favorable and the right to borrow is exercised by the borrower, the seller has to invest so that the borrower is borrowing it. Or in other words, seller will have to compensate for the loss in the interest rate, right? Similarly, for floor, the seller will become borrower. The seller of floor option will become borrower, because tomorrow, if the buyer of the floor option exercises the right to invest, so the floor option buyer will invest and the floor option seller will borrow that amount. Clear? I think the relationship is clear. The way, if we talk about buyer of the option, seller of the option, definitely they are very much different when we compare cap and floor from the borrower and investor perspective. Okay, perfect. Now let's talk about the payoffs of the buyer and seller of cap and floor, students. For cap option and for floor option, the holder or buyer has a right to borrow, right? Here, for a floor option, the holder or buyer is having a right to invest. 10% and 10%, let's take a strike interest rate. Sorry. This is the cap rate, this is the floor rate. Strike price, and this is also called as strike price. Perfect. And let's say the premium is 1%. Again, we're talking about the premium in the form of percentage here, students. Okay. Now, let's say the actual interest rate comes to 12% in both the cases. Now, first of all, students, tell me the cap option has a strike rate of 10%. The actual interest rate is 12%. First of all, it is out of the money or in the money, students. Yeah, tell me. Cap option is out of the money or in the money, students, in case the interest rate is 12%. Come on, Munish and Abrikesh. In the money. Perfect. Munish. Yes, it is in the money. Perfect. So let's move ahead. I think there is some lag. So 2% gain will happen to the holder. Now, if we talk about the floor option holder, if the interest rate is 12%, whether it is in the money or out of the money, come on. It is out of the money, because there is a option to invest at 10%. The market rate is already 12%. So why will you invest through that option? You will invest in the market. So it will become out of the money. Similarly, let's talk about the actual interest rates as coming down to 8%. Oh, very nice. I am getting other answers now. Munish and Viraj. Very good. Out. Now I think the answers are coming, hence I was waiting. There is some lag. Perfect. So let me wait. Yeah, now tell me, students, if the actual interest rate is 8%, the strike rate was 10% as we discussed, right? Now tell me, first of all, cap option will be out of the money or in the money, students? Come on. Very good. Abrikesh has responded. Abrikesh, you are right. Let me wait for Munish and Viraj also to respond. In case cap option strike price is 10%, actual interest rate is 8%, will the holder, or let's say, will the instrument become in the money or out of the money? It will become. No, Viraj and Munish, we are talking about the cap option. We are talking about the cap option. Cap option will become out of the money. In case the interest rate goes down, the cap option will become out of the money. Now tell me, floor option. Okay, let me tell you why it will become out of the money. So always think it what instrument is offering to you. So in this case, in cap option, the instrument is offering you to borrow. Borrow what? Borrow a specified amount at the rate of 10%. Now, if the market is already giving you or quoting you an interest rate of 8%, why will you exercise this option? This option will become out of the money. Correct? You will go outside and borrow it simply. And in case of floor option, if the outside rate of interest becomes 8% and you have a option to invest at the rate of 10%, clear? If you have an option to invest at the rate of 10%, then floor option will be in the money or out of the money? Come on, tell me. I can go in the open market and invest at 8%, or I can exercise this option and invest at 10%. Yes, very good, Abrikesh. Viraj and Munish, you guys are responding. Please respond to this part now. Think and then respond. Yes, Viraj, very good. Yes, very good, Munish. So both of you are correct. It will become in the money options. Clear? So the payoffs are clear, students, right? When it will become in the money and when it will become out of the money. Yes. Now, students, please pay your 100% attention because we are going to discuss about the interest rate swaps. And this is very, very important. Okay, so this is going to be a reasonable discussion. So I request all of you to please pay your 100% attention. Okay, because any one thought missed in between will lead to entire topic not being understood. Now we are coming to interest rate swaps. So students, in this case, interest rate swap is actually another form of interest rate risk management strategy in the modern method, right? And this is the last form. Now, what happens? There are different forms of borrowing for different types and different maturity companies, right? Or let's say for different company profiles, there are different forms. For example, if I talk about a company A, which is a well-established company, right? The margins are good. The business is also very much established. It is happening. There is no issue in terms of the overall business. And they have reached at a level where they feel that, you know, they will be able to take up the risks because their risk taking capacity is higher. So what they say that today, if we want to borrow something, we will borrow it using the floating rate of interest. So they will prefer floating rate of interest. See, ultimately, once any borrowing happens, right, there are two ways in which a rate of interest can be entered into, either in the form of a floating rate or in the form of fixed rate, right? Generally, the long-term financing happens on a floating rate. Let's say I'm talking about 15 years or 20 years of a home loan, where the bank will not commit itself to a fixed rate. It will always ask you a floating rate, because bank would want itself to be covered, right, on how it is getting sourced, those you know amounts that the bank is lending to you. So generally, we have seen that in the case of higher maturity loans, there is a floating rate, and the risk taking capability of company A is such that they prefer floating rate because they are well established. So they went to their banker, bank A, right? As of now, only focus on what I'm discussing. Then we will again weave everything into the entire case discussion. So the bank A gives two kinds of quotes to company A. So company A has its own bankers, right? From those bankers, they have selected bank A. Bank A has given two different types of quotes. It says that, okay, if you want to borrow from me, I will give you a fixed coupon at the rate of 7% and a floating. If you want to borrow from me on the floating basis, I will give you my borrow. Okay. Okay. So there is a quote that is available. The company A says, okay, I will prefer floating. I will prefer my bird. Now, there is another company called Company B, and it's a very new company. It's a startup, right? It's a startup company. And hence, they are running low on lot of things. They're running low on cash. They're running low on profitability. And hence, they are preferring to be fixed in terms of the borrowing that they want to do. They don't want to prefer a floating rate of interest. The reason is very simple, because tomorrow they don't want to take the higher risk. If tomorrow the borrowing rate increases, they will not be in a position to take up that higher amount. So their preference is fixed. Okay. Now they approach their own bank, which is called as Bank B. Okay. Now Bank B is quoting this. So this is again a quote from Bank B to Company B. So there is a fixed coupon at the rate of 10%. There is a floating of MIBOR plus 1%. If you see, Bank B and Bank A's quote to Company B and Company A respectively are different. What will be the reason, students? Can you tell me? In fixed coupon, there is a difference of 3%. In floating coupon, there is a difference of 1%. Here it is MIBOR, here it is MIBOR plus 1%. Very good, Abrikesh. Abrikesh has responded. Let me tell you, it's because of the different risk profiles of the company. Company A and Company B. Company B is well established. Company B is new company. New company might have higher risk. Higher risk means higher interest rate. As I said that interest have two components, risk and time value of money. So if higher is the risk, higher will become the interest rate. So fixed coupon is higher compared to company A, right? Now, both of them have their own preferences. See, one option is company A will go to bank A and say that I want to take it on a floating basis. You're giving me MIBOR, I will take that MIBOR. Similarly, company B will go to bank B and it will say, oh, this is your final quote, fixed coupon, I will take preference as 10%, I will borrow at 10%. Simple. But what if we do some interesting things here, and make the overall cost of borrowings for company A and company B lesser than that. Yes, Manish, you're right. Lending to company B will be risky. That is why the company B's bank B has quoted a higher rate. Now, option one, students. Option one is that bank A borrows in fixed and bank B borrows in floating, which is 7 plus M plus 1. So this becomes M plus 8 in totality, right? We are talking that one company can borrow in fixed and second company can borrow in floating. What is the overall cost of funding, which is M plus 8. Now let's reverse this situation in option 2. Let's say floating is entered by A and fixed is entered by B. That becomes M plus 10. This is the preferred one. Huh? This is the preferred option. So the preferred option is proving to be costly compared to option 1, right? Option 2 is proving to be costly when we compare it to option 1. Now, what should they do? So both of them actually approach a third bank, which is I'm taking a name of swap bank. Okay. Now this swap bank will understand about the company A's requirement and company A's availability, company B's requirement and company's B availability. So what is available with company A and company B in terms of the quotes? What are their preferences? How would company A prefer? How would company B prefer? Clear? So swap bank will also do this calculation. If I do option 1, if I do option 2, then what is the difference? And swap bank will arrive at C. Okay, option 1 is the best option because in this the overall cost of borrowing is coming down by 2%. From M plus 10, it is coming down to M plus 8. Okay. The moment we say that, now the company A will say, see, you're asking me to borrow in fixed. However, my preference is to borrow in floating. So swap bank says that, see, I am there. I will help you out. You do one thing, you borrow in fixed. So swap bank says that, so this is how swap bank will say to, this is what exactly swap bank, company A, company B. So company A, it will say you go ahead and borrow in fixed at the rate of 7%. And company B, it will say borrow in floating at the rate MIBOR plus 1%. Clear? This is the actual outcome of swap bank. And the moment it says, then company A is not comfortable with it. So what swap bank says to the company A is, okay, I will do one thing that ultimately you will be taking a loan and you will be paying 7%, right? So what I will do, I will give you 7.75% in return of this 7% and you pay me MIBOR. First think through, students, then I will tell you how this is formed actually, okay? But think through what I'm step by step, what I'm trying to tell. So swap bank will say that, okay, your ultimate liability 7% of interest. What I will do, I will give you 7.75 as fixed. I will keep on giving you 7.75 as fixed. And in return, you give me MIBOR. So I'm swapping your fixed obligation through floating obligation. So you have a fixed obligation of 7%. No, Abrikesh, 0.75, there is a way how it has been arrived. I will tell you. Okay. So as of now, just go ahead with this number as 7.75 simply. It can be any number. So what will swap bank say to company A is, see, you have preference to borrow in floating, but I have told you to borrow in fixed. Now you do one thing, you swap your fixed borrowing to floating borrowing by paying me my MIBOR, and I will pay you 7.75. Okay. Similarly, now coming to company B. Now swap bank will tell company B that ultimately you are end up paying to bank as M plus 1%, which is not your preferred way, right? Your preferred way is having something fixed. So you do one thing, you pay me 8.25 as fixed, and I will pay you MIBOR. Reason being, I will pay you MIBOR, and the same MIBOR equivalent you will pay to the bank, and plus 1% definitely, but that 1% is fixed, right? So I am swapping your floating obligations to the fixed obligations. So this is there, and swap bank will swap fixed obligations of company A with floating obligations of company B. Definitely with some difference, right? With some commission or difference or gain, whatever you want to say, it will not be exactly same, but there is a difference, right? The numbers were different. There were some random numbers that I've put here. One is 7.75 and second one is 8.25. Now we will come to that, how it will happen. Okay. Now, ultimately, if you see from company B's perspective, company B is receiving MIBOR and it is paying MIBOR plus 1%. So MIBOR receiving, MIBOR paid. Ultimately, 1% is there and 8.25 to swap bank. So ultimately, 9.25 is the cost. For company A now, it is paying MIBOR, paying 7% and receiving 7.75. So the overall cost of borrowing becomes M minus 7.75. See, after swap, company A, MIBOR is paid to swap bank. This is paid to bank A and this is received from swap bank. Okay. For company B now, MIBOR plus 1%, this both is paid to bank B. 8.25 is paid to swap bank and MIBOR is received from swap bank. Simple. So MIBOR plus MIBOR minus will get cancelled and 9.25 will remain, which is the fixed amount. And here it becomes the floating amount. Now, if you see students, total collective interest payout is MIBOR minus 0.7, which is A. And this is for B. So overall, it becomes MIBOR plus 8.5%. And in this now swap bank will say, I am not doing anything for charity, right? I will also expect something. So what will swap bank will say that, okay, the lowest borrowing option was M plus 8%, right? Option 1 was M plus 8%. So what I will do, I will add my commission and make the overall cost as M plus 8.5%, and then I will distribute it. Okay. So ultimately, my bar plus 8.5% is coming from company A and company B. Out of that, 0.5 is kept by swap bank. And my bar plus 8% is going collectively to bank A and bank B. Clear, students? Till now, clear? Now let's compare this situation. If there is no swap for company A, now, okay, most of you will be thinking why we have done this thing. What is the real benefit? Yeah, I will come to that, Abhikesh. I'm just coming to that only, how this 8% is shared. Okay. My discussion is not over yet. There are a lot of things. So I was saying that M plus 8% was the outcome of option 1, right? Here, this one, M plus 8. Now, this M plus 8, let's compare first of all no swap and swap. So if there is no swap, company A will end up paying my bar, right? And if there is a swap, then the effective borrowing cost for company A becomes MIBOR minus 0.75. So don't you think there is a savings of 0.75 that has come in here? Yes. For company B, had there been no swap, the company would have taken a fixed borrowing at the rate of 10%. But because of swap, the effective borrowing cost of the company comes out to be 9.25. No, Munish, as of now, I've taken a hypothetical situation to explain you the swap, right? But practically also it happens like the similar manner. So 9.25 becomes the swap effective cost for company B. So company B also enjoys a lower interest rate because of swap to the extent of 0.75%. Now let's talk about swap bank. No swap, there is no commission. In swap, there is a commission of 0.5. So ultimately 0.5 commission also is earned by the bank. So the total benefits to company A, company B and swap bank is collectively 2%, students, right? 0.75 plus 0.75 plus 0.5. That is 2%. Now, how this 2% is coming? The overall cost in option 2 was M plus 10. The overall cost in option 1 was M plus 8. So do you see this difference of 2% arising out of here, which is distributed in such manner that first swap bank will take out its own commission and balance will get distributed equally between company A and company B, or in some other proportion, that is swap bank, company A, company B to decide. It can be, let's say, higher benefit will be given to company A. Let's say 80% benefit can go to company A. 20% benefit can go to company B. That also can happen, right? I've just taken a very simple example where the gain has been distributed 50-50. So now, Abhikesh, you were asking, right? How have you arrived at this 7.75 or this 8.25, right? So this 7.75 and 8.25 is arrived at after keeping into mind what is the benefit that has to be shared with company A and company B, which is 0.75, right? So if 0.75 has to be shared, that means MIBOR minus 0.75 has to be the overall rate, and already it is paying 7. So the swap bank will pay 7.75 to the company A. Clear, students? So this is called as the swap, interest rate swap. So what has happened in interest rate swap, students? First of all, there is a savings component that is there. That is fine. Second is it is also helping you to align your risk management objectives to what it is available for you to act. What is your risk management objective? For company A, the risk management objective was to borrow in the floating basis. For company B, it was to borrow on the fixed basis. So by doing this, they are able to align their overall risk management objectives with what it is available. Now, what is available? Available are both the options, but the best option available is option number 1. And this is called as a fixed to floating swap. Now, if you see only one leg, one leg of, let's say, one leg of company A, that you will call as converting the fixed to floating, right? For company B, you will call as converting floating to fixed. Clear? So if you see only company A, the objective is to convert the fixed borrowing to floating borrowing. Now these products, now let me come to practical life. Okay. Now this is the entire case study that we have discussed to understand how the entire process works. But in practical life, the process has a lot of different things attached to it. For example, swap bank. The role of this swap bank is to swap your fixed obligations to floating or floating obligations to fixed, right? That swap bank can do. And in the back end, it's not necessary that only two companies are involved, company or company B. There might be n number of companies that will be involved, right? So swap bank has lot of calculations running in their database that will say that what is the right amount to be given. That is point number 1. Point number 2, swap bank. Okay, wait. Munish is asking, I mean to say that company A and company B should come at the same time to swap bank. That is what I'm telling now, practically how it happens. It's not that, see, this example has been framed with exactly the same amounts, right? Company A is in need of 1 lakh. Company B is also in need of 1 lakh. Then only this swap will be effective, right? So there are a lot of inherent assumptions that has been taken to just keep you understand that what is the real meaning. But practically I'm coming. So practically I'm telling it's not only two companies. There are multiple companies. There can be multiple companies on companies B's position. There can be multiple companies on companies A's position. So swap bank will take multiple companies position and it will put it onto the multiple companies position. That is one. Second is the notional amounts. Sometimes the notional amounts become similar, but most of the times it is not same. So it is again up to swap bank how much notional amount swap bank is agreeing for the same, right? That is second point. Third point, swap bank also takes into account the different credit risk considerations because swap bank to company A will not be an issue, but swap bank to company B will be an issue because company B is a startup company. Now, what will happen if this 8.25 percentage company B is not being able to pay to swap bank? Then there is a problem, right? So in a way, what I'm saying is practically there are a lot of things. So swap bank practically customizes the swap according to company A or company B. And in the back end, swap bank will take whatever position that swap bank has to take. Okay, Munish? And okay, other students? This is what I was trying to say. Let me see what is left in terms of the concept. So students, there were very good questions that we have discussed in the detail in the classes. I request please go through them in very much detail as they are very much important. So yes, I think IRS interest rate risk management is over. Now let's come to the business valuation, students. Perfect. Okay. Now, business valuation, students. So this is second topic of today's agenda that we have to discuss. Okay. Now, students, think of now IRS is over. Okay. So IRS, whatever we have to discuss, we have discussed. If there is something that is you are having any query or any question, please do let me know. Munish is asking, are these same commercial banks or some different? No, these are same commercial banks. These are similar banks can give you a loan. Similar bank can convert that loan into fixed from floating or floating to fixed, whatever you want, right? So the banking system is very much similar, Munish. Now, with IRS, I think we complete one of the very good topics, right? Because in IRS, our understanding become in depth when it comes to the different methodologies, how we can hedge our interest rate risk, right? Now let's come to the business valuation, students. Now, business valuation is an important topic. The reason being, the valuation is needed in a lot of things as on date. If I talk to you on Ind AS, Indian Accounting Standards, Ind AS 113, right? Fair value measurements, and lot of so Ind AS 113 prescribes you how to value, right? Lot of things. Similarly, Ind AS 103 business combinations tells you need to value your entire business that you are purchasing, and you have to allocate that value to each and every assets and liabilities for that matter. Now, the point I'm trying to tell you is that this business valuation is not only restricted to the current subject, it is even very much relevant in today's scenario in the practical world in lot of positions, right? So hence, this is very, very important, students. So yeah, students, let's start. And meanwhile, I would suggest that we can open up the session for the verbal interaction, right, with the students. So technical team, we can open that because we are into the last half an hour, right? So any queries, again, for the people who are on call in the Zoom meeting can ask verbally, right? They can raise their hands and we can unmute them to speak on this topic or previous topic or any other topic. We will take it up. Now, business valuation, students, in this, we will start our discussion with some of the key concepts that all of us are aware, but still we thought of putting it in starting point. So first of all, are we clear on present value and future value concepts? The answer seems most likely yes, because present value and future value we have taken in lot of places. Whenever, as a concept, as a financial, as a as a finance professional, present value and future value plays a lot of roles in these calculations. Because of the similar reason, the value of rupee today is not as good as the value of the same rupee 1 year from now. Correct? So in a way, the present value and future value will help you to toggle between today and past or future, whatever you want to say. Right? In this, a very important thing that we discussed in the derivatives part also was the continuous compounding, students. Right? So while there are ways and means to arrive at the present value from future value using monthly compounding, daily compounding, quarterly compounding, okay. However, there is a concept called continuous compounding. In continuous compounding, the compounding is happening continuously. Every second, every moment, the compounding is happening. Okay. And that we use e raised to the power the number of months along with the time period along with the interest rate to arrive at the continuous compounding factor. Right. So this is there on the present value, students. And from a business valuation perspective, where this present value is used. Now, imagine that you are valuing a business. There are different ways and means that we will discuss, right? So at that point of time, I will tell you that present value, how it is used in that particular method. So it is used in the discounted cash flow method. I'm just putting it discounted cash flow, DCF, discounted free cash flow, DFCF. Okay. Then second is IRR. So IRR is something where the cash outflow is equal, the present value of cash outflow is equal to the present value of cash inflow. This is that discounting rate. So this is a discounting rate at which present value of cash outflow is equal to present value of cash inflow. Clear? Now, higher the discounting, higher the IRR, that means better the project is, right? Because it will give you a higher return. Internal rate of return means it will give you a higher return, students. Then ROI. ROI is simply your return on investments. Whatever amount you have invested on that, whatever return you are getting becomes your ROI. Then Gordon's growth. So there is a formula for the dividend that we have discussed is Gordon's growth model. So it says that whatever is your next year's dividend, if you divide that by your growth, sorry, if you divide it by the difference between your cost of equity minus growth, you will arrive at the value. Value of what? Value of the equity, right? Because dividend you pay on equity. Okay, can anyone tell me what is the difference between the equity valuation and the business valuation? While we say business valuation, is it as good as equity valuation, or equity valuation is something else and business valuation is something else, according to your understanding, students? Munish? Brikesh has responded. Yes, equity valuation is like valuation of equity, but what about business valuation? Perfect. No, even net worth is also equity, right? So net worth is also equity. No, Munish is saying same. No, no, no. Wait. Okay. Let me respond. So business valuation, students, is actually, so while we say business valuation, okay, the thing that comes to our mind is that what is the income generation capability of the business? Now, whether it is invested in the form of equity or in the form of debt, that we don't think. So business valuation is what your business is capable of being valued. That is debt plus equity in simple form. And equity valuation is out of that business, if you remove your debt, what is your equity valuation? Simple. Okay. So this becomes cost of equity, and growth is actually B into R. So this is a formula that we have studied earlier. B into R is retention ratio B, and R is return on investments, right? And this R, return on investments, is again the internally calculated number. Here, R is actually ROI, B is actually the retention ratio, and hence growth is equal to B into R. Finally, the terminal value is also that we know, right? Terminal value in any of the project is actually once the project life gets over, right? What is that project going to give us? Let's say the project life is 5 years. After 5 years, what is the ending value, or let's say what is the terminal value of that project? WACC. WACC is weighted average cost of capital. I think this we have discussed in one of the sessions, one of the live sessions. So this is the respective cost, let's say cost of equity, cost of debt, cost of preference shares multiplied by their respective weightages. Now, there are different approaches to value and enterprise. Now, let's discuss the three broad approaches. The first approach is asset-based approach. I'm just putting it here one. So this is the asset-based approach. Asset-based approach means that what is the value of your real assets appearing in your balance sheet. So one is net assets value. Net assets value is what? Fixed assets plus net current assets minus long-term debt. Simple. NAV is what? You take your fixed assets from the balance sheet, you take your net current assets, and you reduce your long-term debt. So this is called as historical cost or book value, right? Now, net realizable value is actually what? Again, based on the assets, we see that what is the liquidation value or what is the adjusted book value. See here, we just simply go with the book value. Here, we do some adjustments to the book value, and that adjustments is what? Adjustments is that today if we are going to sell it off, then what is the liquidation value? Or is there some kind of an adjustments that we need to do? For example, the debtors are standing at, let's say, 10 lakh rupees. Out of that 10 lakh, we know around 10% are going for a default, and that 10% provision is not yet done. So we will adjust it for 10% as a specific adjustment. Then third is the replaceable value. Replaceable value is an asset-based approach. Sorry, no. So replaceable value is if you replace your existing assets with a similar outside assets having the same wear and tear, having the same condition, then what is the real value? But the only drawback of the asset-based approach is that it is not forward-looking. It is always looking what you have currently in terms of your historical assets, in terms of your historical cost. It does not even place any reliance on whether your business is able to earn any margins or whether you are able to derive any benefit or what is the growth plan in the business. Nothing is taken into account. Only the current replaceable value is taken into, or let's say the current, from a current perspective, replaceable value, from a historical cost perspective, the net assets value, and from the realizable perspective, the net realizable value is taken into account. So this is relatively simple, students. And this is again to value and enterprise. Now, this is very, very important. Cash in income-based approach. This is really important. This we have seen in practical life. So I can tell you, if you see the India's 36 impairment of assets, it deals with the calculation of recoverable amount. Now, recoverable amount is value in use or fair value less cost to sell, right? These two things we say. So cash flow based approach is actually value in use. And income based approach is fair value approach while we arrive at the recoverable amount. Okay. I'm just giving you a reference because practically we do this. So income based approach. Now, what is the real benefit of income based approach? in the assets approach, as I was saying, that assets approach doesn't takes into account any income generation capability of the business, how business has performed in the past, or what likely business is going to perform in future, right? So in income based approach, we first of all calculate the FMP, which is called as future maintainable profits. What are these future maintainable profits? Now, students, whenever we talk about valuation and specifically income based approach, we have to always be cognizant of the fact that whatever I'm earning today is a result of lot of abnormal things. For example, it can be some of the abnormal gain. For example, it can be because of some of the abnormal loss. It is not a future maintainable profit. Now, what do we mean by future maintainable profit? Future maintainable profit is something that you expect in future to occur as a normal course and any growth in that, right? So what you do, you take your historical numbers, adjust for any abnormalities, and see whether from a future maintainable profit perspective, it is looking good. So that is called as FMP. Second, we use PE multiple or capitalization rate, students. What is PE? Price earnings, that we have discussed earlier, right? In detail, price divided by earnings. So that is 1400 divided by 140. In this case, we have taken an example. Let's say 1400 is the price and earnings per share is 140. So the PE becomes 10 times. The capitalization rate is KE, cost of equity. So you take future maintainable profits, either you multiply it with PE or you divide it by the capitalization rate. You will arrive at the business value. Clear? Now the next is cash flow based approach, students. So the cash flow based approach, we make use of the discounted free cash flows. First of all, can anyone attempt why we use free cash flows? Okay, what is the meaning of free cash flow? What is the meaning of free cash flow, students? No change over time. Okay. Free cash flow, let me tell you, students. Should we wait for any other responses? Okay. Now, free cash flow, why we call it as free cash flow? Now, let's break up free cash flow into two parts. One is cash flow and second is free. Now, cash flow is a cash flow, right? That you earn from your margins in the business, that you earn from EBITDA in the business, right? The free cash flow is actually after reducing any capex. So cash flow from operations minus capex outflow is called as free cash flow in the finance terminology. Okay. Discounted means that we are doing the present value. Now see, I told you now, where are we using present value concept? In DFCF, discounted free cash flow method, right? Okay, clear? Yes. So Munish is saying net cash available to business. Very good, Munish. Because this much you earn from the business and this much you invest back in the capex cash outflow. Capex means capital expenditure for the business purpose, for the investment purpose that you're doing. That is called as free cash flow. So this is net cash available to business. Very good. Now, if you see, let's take an example of 4 years. 0 to 1, 1 to 2, 2 to 3, 3 to 4. So there is a present value of explicit period, which we call as free cash flow. Now, what do you mean by explicit period, students? Explicit period is up to this 4th year. These 4 years are called as explicit period. And this terminal value is called as the terminal year. So this is a terminal value, right? Explicit is where we are making each and every assumption and we are trying to arrive at, for those years, what are going to be the free cash flow estimates. Okay. And terminal value is the value of the business after the explicit period, that either the business will continue perpetually or we are going to sell the business. If we are saying that the business is going to continue perpetually, then what is that perpetual value at the end of terminal value? At the end of this explicit period that will come, that is called as terminal value. Okay. Now what we have to do for business valuation? We have to find out the present value of the explicit period related free cash flows. This is the discounted cash flow plus present value we have to do even for the terminal value, because terminal value is after 4 years, right? So that will give us the overall value, students. Now let's come to economic value added. This is again important concept, students. Now, economic value added is actually what your business is earning and what is expected out of the business. See, this is actual and this is expectation. So we expect WACC, right? WACC is the expectation of each and every instrument holder, equity, debt, preference. So weighted average of that is the expected return minus actual return. Simple. Actual return is represented by NOPAT, net operating profit after tax. Why we are taking net operating profit? Because we are ignoring interest here. Because that interest charge is also part of WACC, right? So this capital charge that we are talking about also includes the interest. Hence, we are ignoring here. Otherwise, it will get double counted. This is also EBIT into 1 minus tax rate will also give you the same thing. Net operating profit after tax. Clear, students? EVA is also used in practical life to assess any project, right? To assess any project, because in this, we are not making use of cash flows. We are not making use of present values. We are making use of the real profitability, right? What is your operating profit after tax? Whether that is meeting the expectations or not. Okay, let's move ahead. I think there are a couple of points that are left. Market value added was there. Let me just see. Okay, this one is also important. So as we discussed, what is the asset valuation, or let's say what is the business valuation, what is the equity valuation? Similarly, here we're talking about the asset beta, equity beta. Okay, this is the equity beta. And this is a debt beta. So whenever we say that asset beta, or we also called it as ungeared beta. Why ungeared? Because debt is also getting added here. Equity is called as geared beta. Okay, equity beta is called as geared beta. So the formula to calculate is equity beta multiplied by equity proportion of the capital divided by equity plus debt into 1 minus tax rate. And similarly for debt, we will multiply with debt. So E is equal to in equity, we take share capital plus reserves and surplus, because reserves and surplus are also part of equity, and D is equal to debt. So T is equal to tax rate. So in a way, we can say that always equity beta is higher than the asset beta. Reason being, this is general outcome. Reason being, debt beta is very low. So this will drive your asset beta to lower than equity beta. When D becomes 0, then asset beta becomes the equity beta. If BD becomes 0, then asset beta equation will be reduced to this much, students. Clear? Now, I think market value added is again the market capitalization, the current market value minus equity invested amount. Simple. So market capitalization is from the market perspective. Let's say it is listed on a recognized stock exchange. From that, what is the price being quoted multiplied by the number of shares minus equity amount invested. This is the book value. This is the book value. This is the market value. This is called as market value added. The difference between these two is market value added. Now, shareholders value analysis, students. Perfect. Let's start from here. So, first of all, as we said that in DFCF, we have to calculate the free cash flows. Free cash flows will start from EBIT. We will reduce interest here. We will arrive at EBT. EBT minus tax, we will arrive at EAT, earnings after tax, correct? In that, we will add back the depreciation. We will reduce the working capital requirement. We will also reduce the incremental cash capital expenditure. This we already know, right? Only new thing that has come is any working capital requirement that also we reduce, right? So this becomes our free cash flow. Why we are adding back depreciation? Because depreciation is a non-cash item, right? Hence we have to add it back. So what I'm saying is, in totality, let's say the total value, let's say terminal value is 1000 and explicit value is 500, it comes out to 1500, right? Can we say that 1500 is the equity shareholders value? No, right? The total present value is 1500. Okay. In that, there are some outside investments. If you see the balance sheet of this company that we're talking about, this investment is outside the business and this non-current borrowings is in the business, right? So we will have to reduce the non-current borrowings because this is a overall valuation, right? Now to arrive at equity valuation, we have to reduce the borrowings and we have to add what we have invested outside because this is given by the investment in your business. 100 is invested outside. So 1550 becomes the business, the book value, the value of the equity, students. And again, SVA is forward looking. Now just a comparison, EVA is historical, MVA is as on date, and SVA is futuristic. And as I said that business valuation is equal to equity value plus debt value or only equity value. I think these were some of the questions on the chop shop method. This was easy. You have to just multiply the requirements given in the question along with what it is given. I think that's all. Let's come to this MCQ, students. Let's spend some time on the MCQ. This is for both. This MCQ is for both interest rate risk management as well as business valuation. So question number 1, students. Dash is a right, not an obligation, and acts as an insurance by allowing business to protect themselves against adverse interest rate movements while allowing them to benefit from the favorable movements. Come on, students, tell me. After the entire discussion of today, tell me what is the right answer. Very good, Abrikesh. Abrikesh has responded. Are we expecting any other answers, students? No, Munish, please recheck. The correct answer is D. This is the correct answer because interest rate options is a right and it's not an obligation. Interest rate futures is a obligation as well as it is a right, right? It depends on how the condition is phasing. But interest rate options is definitely it's not an obligation. Question number 2, students. The seller of dash compensates the buyer of option with a payoff when the interest rates falls below the strike rate. Is it a floor option? Is it a call option? Very good, Abrikesh. It's a asset liability. What it is? What is the right answer? Come on. The seller of dash compensates the buyer of option with a payoff when the interest rate falls below the strike rate. Come on, students. The floor option. Very good. Next, prices of dash are determined by demand and supply and are inversely related to the prices of the underlying bonds. Just all these things have been discussed in today's session, students. Come on, tell me. Very good, Abrikesh. Munish, I'm waiting for your answers to come. And I request if anyone else is also there, please do respond. So the correct answer for third question is interest rate futures. Very good, Abrikesh. Now the next question. While using capitalization of earnings method for business valuation, dash is divided by the appropriate required rate of return or discounting rate. Very good, Munish. Now I think your answers are coming. Is it actual last 5 years profit, last 10 years profit, expected annual profit, or expected annual maintainable profit? The correct answer is D. Very good, Abrikesh. Then last question, students. Question number 5. Dash approach takes into account the quantum of free cash flow that is available in future period and discounting the same appropriately to match the flow's risk. Just now we discussed, just few minutes back, students. No of the case, just check it again. So the correct answer is cash flow based, because in cash flow based approach, it takes into account the quantum of free cash flows that is available in future and discounting the same appropriate to manage the cash flows risk. Okay, students. So this actually brings us to the end of the revisionary sessions of business valuation and interest rate risk management. Please do study well, revise well, and we will cover up the other topics in the upcoming sessions. Till then, take care and goodbye. Thank you. Have a nice day ahead, everyone.
Thank you. Thank you, Ashok.
Thank you. Thank you. Thank you, Abrikesh. Thank you. Okay. Technical team session over. Yes.